Now we can talk about what's happening in Asia and more specifically what's happening in China and some of those rate issues as we talk about Shibor and what's happening within some of these spikes of liquidity or lack of liquidity in the market in general. So this is just kind of set this off of where is the MS Asia Risk Sentiment Indicator. Its latest reading as of January month end is at the 94th percentile. So when we think about where we're getting to an elevated level of where we're getting extended, there's obviously a lot of people that are very bullish and they're looking to push money into the market and they're looking to increase yields. So what does that mean? That means you go into emerging markets, and you can see here just an example of how you can get a bit extended in this and you're in an overbought situation. Now you can see at the bottom you can remain oversold for a very long period of time. Again, it's just a way to look at where are fund flows, where are positionings, and then what can happen over the next few months. Now, before we get into China, we should talk about South Korea. So South Korea so far has been fairly strong when we look at what's happening on export-import side. But here you can look at the surprise to the upside on the unemployment rate. And it was really a pretty big spike in general, just going back over the last several years. Now, this is going to be a bit concerning just because they do have pretty stable COVID cases that they're trying to work through. And that's something where they're going to continue to see just a general slowdown of activity as they address and try to slow the spread that's currently happening over the last week or two. And that's really impacted unemployment rates. Now, just given, obviously you can see kind of the lumpiness in general, I would expect this to normalize a bit. But again, it's not going to normalize back down to that 3.5%. It's just going to, I think, come back down to that 4.5% in general as we have issues that are just going to remain within just the activity level of South Korea in general over the next few weeks. And then when we look at Japan, there's some benefits in terms of what is some of the activity that's happening right there. The economic watcher surveys, they were slightly better than expected, still well below where they should be in general, or you can see kind of the lumpiness in general from the period of earlier. And then you saw some increase in earnings as we saw cash earnings go up 3.2, only down 3.2%, beating estimates. But when you look at versus prior, they're moving in the wrong direction. So they're still better than the survey, but the trend is moving incorrectly. So the hope is to kind of see that turn around. Machine tool orders year over year, still positive, still growing, but growing at a slower pace. And again, these are things that remain an overarching problem as we start to think about where is going to be the next push to help pull the economy higher, specifically in Japan. That's why we talk about Germany and Japan, the third and fourth largest economies in the world. So then when we look at Taiwan is just, again, exports, imports. Exports are going to continue to be strong. We keep talking about the shortage in the semiconductors, which again is a big component of Taiwan. They have to import a lot of the raw materials, and then they export a lot of either the finished products or semi-finished goods. Again, these are going to be net benefits or net positives when you consider where Taiwan is at this point. And as I talk about it in Ryan's podcast, this is also going to be a means of an end for China, who needs a lot of semiconductors. They need a lot of fabrication facilities. And Taiwan has a lot of US IP in it. They have a lot of capacity because that's where we've outsourced a lot of our activity for the creation of technological goods that go into everything from cell phones to missiles and secure servers and other types of components. So the Taiwanese supply chain is pivotal to the U.S. supply chain and its intellectual property and just the security of it from a military perspective as well. One of the interesting things is this fertility rates side, because it becomes a bigger problem when you look at how are we going to see additional growth, where do we sit on the fertility rate in general. And when you look at, I think it's below 2.2, you're in a shrinking setup, and you can see that we're starting on a world level, we're starting to pull down below that. China is in a decline. If you look at OECD, it's kind of merging with where China is right now. But South Korea and Singapore and Japan continue to be in a contractionary level. And that just becomes a problem on age of the workforce, which then you have to replace with migrant workers or immigration from other areas. Because if you think about the Middle East and other areas in Africa, they have a younger population that could be a good place to bring intelligent and skilled labor into the fold. Because again, the whole thing is like South Korea has high level technology, things that could be a good attraction for people who are well educated or are entrepreneurs from Africa and other parts of Southeast Asia that can kind of backstop that, especially parts of the Middle East. But again, the trend is going in the wrong direction. Depending on who you ask, those who obviously are concerned about overpopulation, this is moving in the right direction. But when you think about trying to find ways of mitigating some of the internal risks, this is going to become a bigger problem in general, as India is actually on the other side of this as they have additional growth. But China is the biggest concern, as the one-child policy created a lot of issues with where their population is going to go over the next few years. I should say the next decade in general. So then when we look at what's happened across, when we're looking at new COVID cases, those absolute numbers, this is looking at China, you can see that the cases have normalized a bit. The city metro passenger side, that continues to be weak. There are things that are getting a bit worse when we're thinking about just activity. That's just, again, limited movements due to the rise in cases and limiting the amount of Lunar New Year travel. But when we start thinking about some of the issues in general in India, where the benefit, I should start with the benefits first. The new COVID cases continue to go lower. Total active cases, again, continuing to go lower. The vaccine administration is going up. The lockdown index has reduced further. It's now at about 65. The bigger issue is that consumer sentiment, because consumer sentiment continues to be a bit concerning, because you're still not seeing people do as much. Like in the EIA show, we talked about how gasoline prices are at an all-time high, diesel prices are moving higher. It's going to impact the way people are willing to move about, as you see that recreation, the retail movements where people just aren't doing as much. And gasoline price at fuel stations operated by Indian Oil Corp, largest out there. In Delhi, we're at a record of 87.60 rupee a liter on Wednesday, while diesel was priced at 77.73 rupees. Now, this is an inherent problem because Modi, who has increased his budget, this is tax revenue. If you increase your budget, so you already have a budget deficit. If you cut taxes, you're going to increase that deficit. Now, you could say that they're going to try to offset it by increasing economic activity. But again, there's a certain amount of tax concern or shortfall on the deficit side that will limit the amount of movement that can happen in the general near term, with diesel demand down 2% year over year. And last year was actually an easier comp, which speaks to some overhang. Gasoline was strong, but as a smaller component, and naphtha was actually down. Talking a bit more about what are some of the activities that are happening in the market in general. And then when we talk about the market, we have to look at what is happening in copper. And this is something to look at, again, speaking to inflation. Copper exchange and bonded warehouses, inventories versus days of consumption. So you can see on how, in general, we're seeing this movement lower in stocks, in bonded warehouses, and the stock to consume continues to get pulled down. Now, there is a supply chain issue. Chile production is down. You have a certain amount of problems. Again, you have a certain supply chain issue, but we do have more copper being consumed. And these prices are just driving higher. And even if you start to see some of that capacity coming back on, you still have a net shortfall as you haven't been investing in mines the same way. So even if you have demand not as strong as now, the supply is not going to be there to the same level, which is just going to keep prices elevated, which is, again, going to push those prices for raw materials higher, as we talked about with one of the key ones when we were talking about Tesla and some of the environmental options. Then, when we keep talking about the semiconductor industry, it's crucial to Taiwanese exports, as we've been talking about Taiwanese exports, why there's going to be a lot of strength. And when you look at just export orders for Taiwan, export orders, you're continuing to drive higher. The Taiwanese semiconductor company continues to be robust, just based on the year-over-year change, because obviously the demand is there. We've had shortages across the world. You have what is it right now? We have Volkswagen, Toyota, GM, and Ford all have slowed down production due to shortages of semis. Again, some of those are lower margins, so you should see a little bit of an overhang to the Taiwanese earnings. But again, it's a volume game, and there's a lot of volume going out there, as we talked earlier, with the demand for new cars that came as people moved out of the the urban setting. Now, we mentioned one of the things that we mentioned was in Indian inflation, and the issue now was in 2020. You had that spike in inflation, and then you saw it come back down. Now, with the increase in bond yield, with the increase in the government's budget, that concern is starting to rise again of inflation, where you can see as the budget was announced, it went from 5.5 to about 5.8% in a near straight line. And that's, again, going to be something to watch when we're considering what is the central bank going to do, what is inflation going to do, because this is picking up what are some of the bonds going to, what are they going to be able to borrow money at, because Modi's going to have to borrow money in order to meet that government deficit, which is going to put pressure on just the overall rupee and just what is the yield, and then what is their borrowing rate going to be in general. Now shifting into China, as I've been saying nonstop, that the narrative was in the U.S. was going to pivot to China. It's happening. So Americans' rising antagonism towards China is going higher. It's now above Russia. So this is what we continue to see, where the focus is now on what is China doing, why are they doing it, how are we going to address it, and as I've been saying before, I didn't think Biden was going to change all that much his how he was going to address what was going to happen with what Trump has done. He might do it in different ways, but really a trade war or the Cold War or some tightening or problems continue to arise between the two powers that we're discussing now. Now, when we look at Chinese CPI year over year, obviously travel has gotten smoked, and it's just because people aren't traveling. Now, when you think about what is happening right now, it's important to appreciate just what is this going to mean for oil demand, gasoline demand, diesel demand, as people are doing much less, because those ebbs and flows are typically what is going to capture that Lunar New Year travel. And here, if you just look at what happened in 2020 into 2021, there was a lot less travel. And again, that's going to drive down prices. But if nobody's buying it, then you're really not saving much money, because you're not realizing a deflationary price. And everything else, as we showed at the very beginning in segment 1, your grain prices are through the roof, again, causing some of these issues that remain in the system. Now, when we start looking at SHIBOR, because this is something that happened at the end of in January. So typically, the PBOC will inject liquidity into the market ahead of Lunar New Year in order to provide liquidity for people that want to take money out. And they're going to travel and they're going to take money from their bank so that they have money to spend with their family, when they go home, hanging out with friends. But they've been trying to pull liquidity out of the market. So they've aggressively been trying to get liquidity out of the market that was really pushed in really through all of 2020, coming out of 2019, obviously, to address the issues with COVID. But you can see that they pulled it out too fast. And by pulling it out too fast, you actually created this SHIBOR shock. And even after the shock pulled away, now there's a fear of, was it just a liquidity issue? Is there a problem with some of the balance sheets, with what people were demanding? Because when you're looking at the overnight, this is what, the SHIBOR fixing on the overnight side, This is what banks are transacting with each other. And we saw what that led to in 2007, 2008. We saw what that led to in September of 2020. And again, this is just a canary. I'm not, and maybe the canary survives, and this is nothing. This is just to pass. But again, you're seeing just the level at which it's increased, because this is a level it hasn't been at in years. And that's why when we look back over time, so let's look at the 1 week, and I can do this with really any time frame in general. When you just look at what the fear has been, and what the rates have done, and you're just not seeing it normalize lower. So I just want to pull out to the 5-year, and you could see it's moved down in general as they've been very lenient in trying to push liquidity into the market. If you think about 2017, they were averaging closer to about 2.9%. You're looking at it right here at about 2.217. So clearly there's still room to go, but the spike actually took us to a high of 3.2%. So you're up at about 3.2%. In 2017, you were closer to about 2.9. So what was the blip? And that's going to be a concern. Was it mismanagement on the PBOC side? Is there an issue at the banking level? And these are going to be concerns that they're going to have to address over the next few weeks, especially when we start looking at China's offshore bond defaults. We talked about this last week. I wrote about it earlier, but the Unigroup defaulted on $2 billion worth of notes in January, comprising the majority of the $2.7 billion total value. Solar power operator GCL New Energy Holdings defaulted on $500 million on January 30th, while MacroLink Global Development missed a payment on a $208 million bond on January 4th. So you can see that we're already kicking off. We're in February, and we're already starting to see this. So China's offshore bond defaults have reached nearly 33% of last year's total in Feb. This, you can say that they're trying to clear things up. It's just there is less and less ability for the PBOC and for others to continue to backstop a lot of this bad debt as collateral becomes an issue and bad debt expense becomes a problem. We talk about in India how they're talking about creating a bad debt bank to take some of this debt off bank balance sheets, strengthen them, and put them into one specific location. And we're seeing something very similar in terms of the issues that are arising at these different banking levels. And why is that such an issue when we're talking about where defaults are on the offshore side and now going back to the onshore side? So growth targets. So most provinces set targets at more than 6%. We keep talking about how the new guard doesn't want targets. The old guard wants targets. So there's a soft target at 5%. But all provinces set their target at 6%. So according to Trivium, this is going to be some quotes from them. Dual circulation. Anybody who's been watching our videos since last year knows that we've been all over dual circulation and what that means for China. And it was going to become the key buzzword as Xi and Congress set that out as the goal for 2021. Dual circulation. Provinces are carving out niches within China's strategy to more closely integrate global trade with their domestic market. Linying wants to be a hub for trade with Northeast Asia. Xinjiang and Inner Mongolia unveiled plans for free trade zones, again, trying to attract more capital, and we'll show why that's important in a minute. Carbon peak. Plans for emissions reductions and energy transitions were common across the board. Digital currency. Wealthier provinces are stepping up digital yuan pilot projects, again, trying to get away from and adopt the digital currencies. Everyone wants to be the base station build out to move faster for 5G. 14th five-year plan. Provinces are developing local plans to help hit the goals of the national one. So again, they're going to find a way to hit their target. And that is going to be through debt, because there's an increasing amount of debt that is needed to support the growth that we're seeing in China. And there's only so much debt you can continue to issue given FX reserves and given collateral before you start to see a bigger problem. And we're getting to that point. Now, poorer provinces are transitioning successful poverty alleviation campaigns into ongoing rural revitalization efforts. All of these will pop up again for the next few months as we talk about the National People's Congress. And despite the chatter, And despite the chatter around growth targets, it's clear provinces are more interested in that high quality growth. So they're trying to, again, drive these things going forward in general. But what is that an issue of? Well, the unequal distribution. So when we look at Linyang, who's trying to increase their opportunities, you can see that they're at the top of the refinancing risk below, followed by Qinzhou and Henan. Now, the problem is, and I apologize if I butcher those names, I am terrible with pronunciations. So when you look at this, there is an underlying fear or risk of how can they refinance the amount of debt sitting at the provincial level. So those stresses aren't distributed evenly across those different countries. The data shows that firms in those three regions issued new bonds equal to less than 30% of the debt that matured over the last 3 months. Firms in other provinces, such as Anu and Zhejiang, were in a much better position, issuing 251% and 171% more bonds than maturing debt. The ratio was 116% nationwide in January. Again, they're not only trying to refinance, but they're also taking on more debt to try to push through these initiatives, which again, there's only so much infrastructure and backdrop you can support in order to try to generate growth across the board. And the Chinese steel margins have declined materially. So we've seen a bounce, but rebar margins continue to go lower. HRC margins are starting to bounce a little bit, but still negative. It comes down to coal prices. They still have their issues with Australia. That's limiting coal imports. The iron ore prices continue to drive higher. Again, commodities tightening overall margin activity. So then when we think about the jump in credit, so again, trying to generate that credit, banks make a record amount of yuan loans in January. If you just look going back over the last few years, you can see total social financing is back to that high, with new yuan loans going to a new all-time high going back over the last however many years you want to go. Debt among state firms in China grew from 130% of GDP in 2019 to a record high of more than 142% last year. Again, and we're going higher again in so far. If we just look in January, we're already going up. Shadow banking, which is something that the PBOC has been trying to take the air out of and reduce, which comprises entrusted loans, trust loans, undiscounted bankers' acceptance, rose by 415.1 billion yuan. Again, they take things out of the market, and then the moment there's a panic, they allow it all right back in, continuating the problem cycle. Corporate bond issuance bounced back from concerns about defaults at the end of 2020, with 375.1 billion yuan of new debt sold in January. So we had those defaults. They continue. People don't care, buying more debt. Again, seeing the problem here. There was also 243.7 billion yuan in government debt, less than a third of the total in January 2020. So there's this bifurcation of they're trying to, the PBOC is trying to adjust, but given the need for new credit, the need to protect rates, that's why that shock in the SHIBOR is going to become a bigger problem, and we haven't seen it normalize because how much of it is being driven by the amount of debt out there and issues at the bank's balance sheets. So then when we look at the pace of refinancing, it slowed in general, but again, it was going to slow when you have rates spiking up. So as rates start to come down, we should start to see some of that movement higher, and you can see it's still elevated as to what needs to be refinanced across the board. And what is happening with some propaganda? So when we talk about the party in general, the Central Committee's message of young people listen to Xi and the party is what they're telling them, coming from Trivium. Now, some quotes from the Central Committee's message. Remember the words and follow the instructions of General Secretary Xi Jinping. Recognize China's great achievements and realize that today's happiness is rooted in the party's leadership. The guidelines also made note of the audience's needs. We should use simple language to guide children and plant seeds in the young pioneers' hearts to fight for the cause of communism. Again, just trying to unite the party, further trying to tighten control and really drive that initiative forward. But when we look at Chinese debt in general, because we keep coming back to these debt levels and the debt issues in general, you can see just where we sit as of the 2020 second half. China's debt by sectors is now at that 272% of GDP. Now, and the reason why we keep talking about this is because we see GDP slowing down more than what the expectations are, where the expectation is for strong growth, and we continue to see that narrative breaking down a bit and just not being there because it's being subsidized. What happens if those subsidies go away? Well, we've already seen people moving out of China into other parts of Asia to adjust their supply chains, which is going to weigh on the amount of GDP growth they can actually generate. And then when we look at China's overnight money market rates, this is what we've been talking about, just kind of looking at it on a broader basis. You can see that it drops from an almost 6-year high, but not all that much. Again, putting it into perspective, looking at over that time frame. And then when we look at the calculated deficit, so when we look at the deficit in general, you can see that as we continue to go through, the actual budget deficit calculated from official data, percent of GDP quarterly, there continues to be a bigger problem versus what the target balance is in general. And then when we look at that rapid rise in local government debt, this is where we start to get concerned because the SOEs or the state-owned enterprises typically have lower growth, but they are an attractive place to put some of their, what they're incentivized to prop up. And here you can see the central government debt, the explicit local government debt, and the implicit local government debt in general. The implicit local government debt still is going to be backed by the government in general. It's a communist nation. There's a certain guarantee that's given, and that keeps getting pushed through in general, especially when we look at bonds in perpetuity. Perpetuity bonds that were issued by banks, and then other banks bought their perpetuity banks bonds. And again, you can see this, the circular loop. So if you're starting to get fears on the overnight repo rate and you own each other's debt that's in perpetuity, well, you have a lot of leverage and risk to each other. And you can see just that, again, the trends continue to move in the wrong direction. And we continue to see that debt being used as a means of increasing infrastructure. Not to say that everybody isn't using debt at this point to try to stimulate. It's just they've been doing it a lot longer, a lot bigger size of the GDP levels. And the question is going to be, how sustainable is this? And is there a way to work that down? The PBOC wants to, but anytime they try, there are these shocks to the market that make them reverse their course. So these are things that we'll continue to look at as some problems in terms of where could Chinese trade really. Looking at imports, exports, what is the economic prowess going to look like going forward? There's going to be a lot to look at and a lot to talk about. So thanks again for watching. Hopefully, if you have any questions, please reach out to us. You have my Twitter handle. Ask comments and questions in the comment section. Always enjoy the back and forth. So thanks again for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.